Okay. So now with FRA, what we were actually doing with FRA was, we first basically understood what financial statements were. And once we understood what financial statement, then we started looking at the analytical treatments at a very base level. That what if firm uses LIFO, or what if deferred tax assets are increasing or decreasing. So there was a good amount of accounting which was involved here. Now the next subject that we are as of now going to do is corporate finance. Now see, within finance there are various broader parts. This part would basically deal with those people who would want to work as a part of companies who are doing business which is not necessarily financial services. Which means there might be a manufacturing company, there might be a service provider, non-financial, and then you are a part of this company. You are a part of corporate finance team of that company, and then that company might have 10 sorts of different decision making processes. They would want to buy some assets, or they would want to recruit some top level management employee, or whatever financial decision that these people want to do. You would basically help them whether it should be done, whether it should not be done. If your company wants to take loan, or if your company wants to raise money, then as a corporate finance professional, your job would be to tell them how to raise money, how you can save the cost of borrowing, or how you can raise the money in lowest possible cost. Then if your company thinks that they have taken too much of loan, or if they think that their business is not going well, then you will help them build their cost structure in such a way so that their cost reduces, or such that their interest reduces, or fixed cost reduces. Or if your company wants to grow, and then they think that one way of growing is mergers and acquisition. So then you help them decide what companies to be acquired, at what price it is to be acquired. So corporate finance is basically, you are not outside the company and looking at the company. You are part of the company, you have access to all the data, and with that data, you are trying to help the company do better decision making. So now, with CFA, though it's a program on finance, the major focus of CFA is on asset valuations. That means the program is primarily meant for those people who want to work in financial services industry. That is, you want to work in equity research and look at some company and do valuation. Corporate finance is the only subject which will help you if you become a part of the company. And you become a part of that company, and then you want to help them take certain better decisions so that it increases the profit and reduces the cost. Now the first topic that we want to study in corporate finance is capital budgeting, which is all about investing smartly. You want to invest your money into assets or various equipments or buildings in such a way that in the long term it would help company generate or maximize wealth of that organization. It might help them save more costs, or it might help them generate more revenue. So now there is a typical process through which you would have to go through with this capital budgeting. There is a list of items that we will have to go through. You need not write this part, I will tell you what is important to be written. So what is capital budgeting? Capital means you want to invest some amount of funds, and budgeting means that you want to invest it in the maximum possible beneficial way. Now it's a process of identifying and evaluating projects where cash flows will be received over a period longer than 1 year. So you are evaluating a project. Let's say you are a manufacturing company, and you decide that you want to set up let's say you are into cements, and you want to set up a plant in North India. So now when you want to set up this plant, you would have to make substantial amount of investment, let us say 300 crores. And then what you would say is the typical lifespan of this kind of a project is 15 years. So when you invest this 300 CR, you would not receive that cash immediately in year 1 or 2. It would be received over the period of 10 years, 15 years, whatever is the life of the project. So then you would try to estimate what cash flows I will receive in year 1, what cash flows I will receive in year 2, so on and so forth. And then this process of estimating those cash flows, once the cash flows are estimated, then doing certain calculation on them, and then commenting on feasibility of that particular project, this is what capital budgeting is. So first step is You need to generate an idea, which is basic logic that without an idea you would not really figure out what is to be done. Analyze the project, find out how much is required to invest initially, what would be the cash flow. Then create a firm-wide capital budget that if a firm has got 4 segments, then you decide that this segment wants to invest where, this segment wants to invest there, take a cumulative number. And then once you've taken the decision, then monitor that and conduct a post-audit and see if the things are going the way you had originally projected them. So these are the categories. You can write them down and then we will discuss them one by one. No, this is after implementation. It was the entire for administrative stuff. Are you done writing? Yes, is it done? Oh. Let's understand first one. We will try to understand through more of real life scenarios. Replacement projects to maintain the business. So now let us say that you are manufacturing ready-made garments. You are into manufacturing of those garments. Now what you realize is that the current state of machinery that you have, this might get outdated in the next 2 years or 3 years. So now you decide that if I want to replace my machinery 3 years from now, why shouldn't I do it today itself? So there would be pros and cons. If I do it today, I'll have to make substantial investment, but then there would be certain benefits. My revenue might increase, my cost might reduce, right? So you take all these factors into consideration. You build a model. You try to put all those ideas into numbers. That what would be the cost saving, what would be the excess revenue generation, and then based on that, you try to decide that whether it should be replaced now or whether I should postpone that and then replace this machinery at the end of year 3. Then replacement projects for cost reduction. Let's say that currently you are in consulting firm and currently what you have is you have about 100 workstations of your computers and then you have about 50 printers which are currently being saved or currently being installed so that 2 workstations are using 1 printer. This is the current scenario. Now you think that your printing cost is increasing substantially. So what you can do is instead of that, you decide that you would buy 2 expensive high quality printers. So that these would be big unit of printers and then 50 workstations of a computer would share these. So then if I replace them, my current printers were working fine, but if I replace them, I will have to incur substantial amount of cost into investment of these new printers. But then these new printers will help me by saving my printing cost. So is the saving in printing cost sufficient enough to justify the investment into these printers? This decision is replacement project for cost reductions. Then expansion projects that let's say you are into a particular geography, you are a retailer, you are into let's say South India and then you want to expand, you want to come to Maharashtra. So then you would consider that what are your retail costs, how much is the investment and is the project feasible, which are your expansion projects. Same is the case with new product or market development. And then with mandatory projects, for example, if you are a manufacturing plant, and then since there's a significant pollution that is being created, you are being asked to, let's say, have a water purifier installation set up somewhere. So now this is a mandatory project, you cannot do away with this. But then you would still prepare a model and you would try to see that do I have any benefits if I do this. And then ultimately you would give a report to your manager saying that because of this mandatory project, this was the cost that we've incurred on this project. And then there are other category of projects as well. So this is basically a very broad level of idea which will tell you that what kind of capital budgeting decisions you'll have to do. But no matter what kind of investments you want to make in business scenario, each and every business decision which is above a threshold amount, that is done by the corporate finance team, which would prepare a sophisticated spreadsheet. It would do a lot of modeling in future, and based on that they will tell you whether the project is feasible or not feasible. You want to ask any questions? Should we move on? Basic principles of capital budgeting. So write down these thumb rules. Done writing? See now, I'll show you a project which requires you to invest 100 rupees at time 0. Then at time 1, it will give you a profit of 70 rupees. At time 2, it gives you a profit of 50 rupees. And at time 3, it gives you a profit of, let us say, 30 rupees. I give you these numbers and then I ask you that please comment on project feasibility. What is your take on this? We should find out the present value. Okay, so let's say that I take present value of 70 for 1, 50 for 2 and 30 for 3. It turns out to be 120 rupees. Now what should we do? We should invest? Yes, these are discounted values. But these are not discounted values of cash flows, these are discounted values of profit. See, if you have profit, so profit is what? Sales minus cost. So let's say my sales was 120, my cost was 50. My profit is 70. But then this entire sales was on credit and entire cost was on cash. So if my profit is 70 but my cash flow is how much? Minus 50. So not necessary that amount of profit and amount of cash will be same because we use accrual system of accounting. So now we are on to corporate finance, we are not on to accounting anymore, so forget that. Think of it on a very broad level. The way a Bania would think of his business. That I have invested 100, how much extra cash did this generate for me in year 1? How much extra cash did it generate for me in year 2? How much cash in year 3? So if cash generated here was 50, let's say 90 and 20, then cash paid is 100, cash received on totality basis is 160. But since I have received them at different point of time, I should not total them up. So what I need to do is take present value of 54, 1 year, present value of 94, 2 year, and present value of 24, 3 years. Take total of all of these and then compare that with 100. And if I am receiving more cash than what I have originally invested, then the project is feasible, otherwise the project is not feasible. So very, very important point, that decisions are based on cash flows, not accounting income. So while doing capital budgeting analysis, we would not worry about what was the income, we would try to find out what was the cash flow in these years. Next one is about opportunity cost. See, now what it means is, let's say that after passing all the 3 levels and becoming a chartered holder, Mohit decides to start his own business. And then in year 1, Mohit earns a cash of 30 lakhs. But what he says is that if I wouldn't have started this business and if I would have taken up a job, my salary would have been 50 lakhs. So while doing this analysis, we are trying to establish the feasibility of business that he's entered into. We would say that relevant cash flow for year 1 is minus 20, because his opportunity cost is how much? 50 lakhs. One more example, that we were talking about replacing those printers. So if I use my old printer, my printing cost was about, let's say, 1.5 lakhs per annum. If I shift to new printer, my printing cost would be 1 lakh rupee. This 1 lakh is not a cash flow. This 1.5 lakh is also not a cash flow. The cash flow is 50,000. The amount of cash that I could save because of investment into new printer. That means we would take care of the opportunity cost, and then we would consider what is the incremental cash flow. Are we clear with this? Timing is important, which is of course true, because based on the timing we would discount them. Tax is a cash outflow, therefore we will also have to worry about tax. And then this last point, we will cover this separately, so at this stage you do not worry about it again. Should we move on? Do you need a break? Required? Not required? So now, choose and tell me what is the answer. Yes, what is the answer? How many of you think it's 1? I was just checking whether you people are sleeping. It's a LOS. So now we have to analyze different types of project. This is independent project versus mutually exclusive project. Then project sequencing, and then unlimited funds versus capital rationing. Now see, what it means is that there is a project A, there is a project B, and there is a project C. In fact, before this we'll do some basics. Let's say there is a project which requires me to invest 1000. The cash flow that it gives me is 700, 300 and 500. This is year 1, 2 and 3. Discount rate is 10%. Find out whether the project should be accepted. There is a project which requires investment of 1000. Cash flows are 700, 300 and 500. It should be accepted. Tell me present value of cash flows. $260 है ना आपका? $1259. So which is 1260. So now present value of these cash flows is 1260 and what I'm paying out is 1000. So how much is my benefit? 260. So this benefit in capital budgeting terms will be called as NPV, a number that you'll have to live with for next 2-3 years or probably rest of your life, which is net present value. And how did I calculate this? I said present value of all inflows. So present value of inflows, which was how much? 1260 minus outflow, which was how much? 1000. So in this case, this outflow is happening at time 0, but at times the outflow might also happen at time 2, time 3. So in that case, we would also be required to take present value of these outflows. So present value of inflow minus present value of outflow is called as NPV. And can I say that as long as your NPV is positive, you should take up the project? Because meaning of NPV being positive is that your inflows are greater than your outflows, and then the project makes commercial sense to you. So now let's do few more examples. Let's say your outflow is 1500 at time 0. At time 1 you have another outflow of 200. At time 2, 3 and 4 your inflow is 1000, 1500. Discount rate is 10%. Calculate NPV of the project. This is time 0, this is time 1, time 2, time 3, time 4. This is an outflow and this is an outflow. One seventy.
No, it's like
Sorry? Yes, only NPV. How much? 237. See, one way of doing it is, all of you can just spend 2 minutes. It will help you to do future calculations. See, present value of 1500 is 1500 itself. So this is minus 1500. I can take present value of this 200 for 1 year. Let's assume that it comes out how much? 180. So we would say minus 180. We will take total of these. It would be 1680. And then we will take present value of this 1000 for 2 years. This is for 3 years. This for 4 years. We will take total of these. And then we will compare this inflow versus 1680. A smarter and faster way of doing it is you can use the cash flow function on your calculator. So what you need to do is press cash flow. Say second clear work. Clear work is at the bottom of first column, so that entire early numbers would be deleted. Enter your cash flow 0 as minus 1500. Say 1500, use plus minus key to make it negative and don't forget to press enter. 1500, use plus minus key to make it negative, don't forget to press enter. Then press downward arrow, it would show you frequency, ignore that. Press downward arrow one more time. Cash flow 2, say 200, use plus minus to make it negative and then press enter again. So cash flow 2 is also a negative number. Make sure that you enter it as negative number. Sorry, I made a mistake. Cash flow 1 was a negative number. Cash flow 1 is minus 200. Then go to cash flow 2, make it as positive 1000. Yeah. And then go to cash flow 3, make it positive 1000. See, you can. Ideally, we use the frequency when we reduce the number of entries. So if you enter frequency as 2 or you enter cash flow 3 as 1000, the number of entries are same. So both the ways, answer would be same. and then cash flow 4 is 500. Enter all these numbers, then press the NPV key which is on the right hand side. It would ask you for interest inside your interest rate as whatever it is. Kitna tha isme? 10%. And then press downward arrow, it would show you NPV. Press compute, it should give you 237. So you calculated it all that job. It calculated present value of inflows, it calculated present value of outflows, and then it gave you a final answer. Since your NPV is positive here, the project should be accepted. We should go ahead with the project. Are you clear with this? Okay. Now see that ideally when project NPV is positive, what it means is that you are receiving more than what you are investing. So as long as your NPVs are positive, you should keep on doing all those projects, because ultimately you are going to receive more, so that the value of your firm will increase. So now if there are two projects A and B, and this has got NPV of 500 and this has got NPV of 300. My question is, out of these two, which one should we choose? Okay. Out of these, which one should we undertake? Depends on the investment. So let's say you have unlimited access to funds. We should take A. Now the answer to this depends on whether it is an independent project or whether it is mutually exclusive. Meaning of mutually exclusive is I can do only one of the two. So if I can do only one of the two, I will choose A. But if these projects are independent, A has got nothing to do with B, and if I have money, ideally I should do both of them. So as long as NPV of a project is positive and these are independent projects, you will keep on doing all those projects and increase the value of your company. But if these are mutually exclusive, then you would choose the one with highest NPV. So we have done this part. Now see, project sequencing means that when you undertake some projects, what happens is that at times you have to do certain projects before you undertake the subsequent projects. So if there is a series of projects, which is AX, AY and AZ, what you know is that this is an extremely profitable project. You have a positive NPV of 1500, and then this A and Y will have, let's say, positive NPV of minus 300, minus 300. So now the question is that if I could directly do AZ, I would have liked to do this, but it's not possible. So what I will do is I will do this first, do this second, and do this third. I will look at the cumulative NPV of all of these, and then since it's positive 900, I will undertake all the three projects. This is called as sequencing. There are times there are certain projects which are required to be done so that you can go ahead and do subsequent projects. Unlimited funds versus capital rationing. That if you have access to unlimited funds, do all those projects which has got positive NPV. But if you do not have access to funds, so let's say there are A, B, C, D, E, 5 projects. NPV here is 1000, NPV is 500, NPV is 700, NPV is 300, NPV is 1200. The initial investment required is 2000, 500, 500, 900, 1000. Now, let's say that you've got unlimited access to funds. In that case, since all the projects have positive NPV, you would like to do all of them. If you have unlimited access to funds, since all the projects have positive NPV, you would like to do all of them. But if you have limited funds, so let's say the amount of funds which are available are only 3000, then which project will you like to do it? It's actually a bit tricky. Let me make this as, hold on a minute. Let me make this as 1300. So now it would be conclusive. See, one combination is you can do A plus B plus C. But this is not a very smart combination because you get NPV of only 2200. Cumulative NPV of only 2200, 1500 plus 700. So a smart thing to do is to do A and probably to do E, so that the combined NPV that you get is 20. Yeah, we can. If we do this, hold on a minute. 800, 1500. Hold on a minute. Another combination is BCDE. This is 1200, 1500, 1800. Total capital is 2900. So this is not a good combination.
1300 last.
Oh, this was 1300. Sorry. Yeah. Then in that case, this is 1200, 1500, 2800. So then 1000, 2000, 2900. So the combination that we want to choose is this, which is your NPV maximization investments. Have you followed this? So what you can do is you can put all these numbers into your Excel, put the formula. Excel will tell you what projects are to be done. Or if you are very much keen, you can do something called as optimization. Okay, and you can perform all those checks on this and find out. Yes. See, when your NPV is maximized, that means your return on capital is maximum here. So it's the same thing. Okay, so you've got the point that there can be a unlimited fund scenario where you do all the positive projects, or capital rationing where you try to maximize the amount of NPVs. First one is NPV, we've done this. The next one is IRR. Now to do this, we'll have to spend some time. And we'll have to spend some time because when we did your time value of money, we did not do it through the formulas. We did it through your calculator. So now we'll have to spend some time on understanding time value of money through formulas. Now, let us say your present value is, how many of you need break now? Let's take a break, 10 minutes.